Good afternoon, everyone. We are Group Pato, and today my name is John, first and foremost, and one of the members of this group. And today we'll be presenting to you international accounting and finance issues. So today we have with you eight underlying topics to this very to our very agenda today. So moving on to our introduction. So we will be talking about the management of international operations and the differences in the content of financial information, the impact of language and currency differences on financial reporting, strategies to manage exposure to exchange rate fluctuations, and the future of accounting and finance.
Okay, so for international standard and global convergence and financial issues, the first topic we're going to talk about is mutual recognitions and reconciliations. So for mutual recognitions, this involves accepting foreign financial statement as equivalent to local standard, promoting trust in their equalities. It simplifies across board investment and let multinational companies use their home country accounting standard abroad. And for reconciliations, in contrast, reconciliations maintains additional financial statement or adjustment to align foreign accounting results with local standard. It less harmonized, burdensome for some companies, requiring multiple sets of record, and is generally less favor for global convergence. Second would be the first step in establishing IFRS. The International Financial Report Standard were created by the International Accounting Standard Board. This board replaced the International Accounting Standard Committees in 2001. The IASC has been working on global accounting standards since the 1970s, but faced challenges in gaining widespread acceptance. A pivotal moment came when the IASB was formed under International Accounting Standard Committee's foundations. The IASB set out to develop a single high-quality, universally accepted accounting standard. The first significant milestone in establishing IFRS was the release of IFRS 1 titled First-Time Adoptions of International Financial Reporting Standard in 2003. This standard provides guidance for companies transitioning from their local accounting standard to IFRS. The third one would be the International Accounting Standard Board (IASB). The IASB is the independent group that created and encouraging the use of International Financial Report Standard worldwide. It located in London and operate under IFRS Foundation supervision. The IASB is made up of experts from various fields like accounting and financial. Its main goals are to make and promote high quality, universally accepted accounting rules, encourages the adoption of this rule, and make sure that financial reporting stay clear and comparable globally. The IASB also updated the IFRS peri- periodically to handle the new issue and improve financial report qualities. It tries to make IFRS and national accounting rules more similar to reduce difference in global financial reporting. Thank you.
The first topic is Parmalat, Europe and Enron. Now, Parmalat is a dairy company based in Europe. For brief histories, it focused in dairy products. As mentioned before, they used packaging technology, which provided them with a technological competitiveness by pasteurizing milks at ultra high temperatures. They've become the dominant milk supplier in Italy after the law permitted the sales of milk in grocery stores. Now, this is because pasteurizing milk could extend the lifetime of milk on the shelf by up to 3 months. They have also sponsored Ski World Cup and World Champion Formula One team. They were acquired by a holding company while continuing to make profits every year. However, it is just an illusion created by a set of accounting manipulations. So, secondly, accounting issues, as mentioned before, that they create an illusion for their profits. So basically, they purposely commit fraudulent in order to hide its losses and to not disappoint investors and creditors. This is for the investor not to leave and sell the stocks of their companies. They've done this by billing their customers twice for each shipment, which enlarge its sales. Then they use these revenues to secure loans from international banks. In 1995, Parmalat was losing more than 300 million USDs a year. So they created a fake company overseas to make fake sales and to secure the loans and hide the debts. They took an advantage of their methods by secure loans to pay back their old loans. So basically, they make fake sales and then get a new loan to pay back the debt. A journalist then raised several red flags that the company failed to make 150 million pounds, I mean euros, bond payment, even though Parmalat claimed to have money on hand. Their fraudulent activities became public and uncovered a total of 8 billion euros of secret transactions. Then they are filed for bankruptcy on December 24th, 2003. For conviction, Castillo, which is the guy who founded Parmalat, has been sentenced to 10 years in jail for marketing rigging, followed by another 18 years in the prison. His son is also sentenced to 14 years in prison for fraudulent. Then Parmalat is then sued by investors, banks, and other organizations. Now, they have recovered from this already by restructuring. Parmalat will now focus only to specific markets. They have cut their workforces by nearly half, cut the brands from 120 of brands to only 30 left. By 2010, they started to move into more markets again, spreading more to more countries again. They were acquired by Lactalis Group in 2011. By 2017, their revenues are over 6.6 billion euros.
So, our next topic is the crossroads of accounting and finance. The crossroads of accounting and finance refers to the intersection of two closely related fields that play vital roles in managing the financial aspects of business and organizations. So, what are the responsibilities of the controller? First, the role of a company controller is crucial for providing timely and relevant financial information to both internal management and external stakeholders. This includes meeting stock market reporting requirements and adhering to account standards. The difference in financial statements internationally. First, multinational enterprise or M&E are encountering significant challenge due to the diverse accounting standards worldwide. Financial statements vary in both structure and content among countries. For instance, US M&Es use a balanced format for the balance sheets, starting with highly liquid assets and progressing to long-term assets, all balanced by liability and shareholders' equity. In contrast, European companies like Swedish retailer H&M often begin with less liquid assets and move towards more liquid ones. H&M's format combine non-current and current assets with shareholders' equity, non-current liabilities, and current liabilities. British firms such as Marks and Spencer commonly use a format that subtracts current and non-current liabilities from the sum of non-current and current assets to determine total equity. These diverse formats are often influenced by stock market preference, making it potentially confusing for those accustomed to a different format in their home country. So now we talk about the difference in financial statements for internationally. So there's a format of it. So assets is liabilities and shareholders' equity combined, while non-current assets plus current assets equals to shareholders' equity plus non-current liabilities plus current liabilities. And last one, non-current assets plus current assets, but minus by both current liabilities and non-current liability equal total equity. For the difference in the content of financial information, global companies face varying financial reporting requirements and must cater to both local and global investors. Listed companies typically include a range of financial statements in their annual reports, along with the detailed footnotes, which can be a substantial content challenge when targeting a global investor audience. Three critical factors to consider are language, currency, and underlying accounting standards. So the first one is language differences. When company needs to prepare for annual reports in a language other than their native language, they often opt for English, especially if they plan to raise capital on multiple stock exchanges. For example, Sweden's H&M and Germany Daimler both provide their reports in both Swedish and English. For currency difference, companies worldwide use different currencies for financial statements, such as euros or Swedish kronor or US dollars. When converting these results between currencies, analysts most commonly use average exchange rates for income statements and year-end rates for balancing sheets. For the last topic, difference in the content of financial information. The underlying accounting standards. Raising capital internationally presents challenges due to varying accounting and disclosure rules, although the adoption of International Financial Reporting Standards, or IFRS, has mitigated the differences. Disparities persist. Many countries employ different accounting standards for consolidated groups and the parent company, often linked to legal and tax regulations. In contrast, US companies typically use US accounting standards for consolidated financial statements and address any inconsistencies related to tax requirements. So, in summary, companies navigating international markets must address language, currency, and accounting standards variation to provide meaningful financial information to a diverse set of stakeholders.
Factor affecting accounting objectives, standards, and practice. Every aspect of accounting process is influenced by a variety of internal and external factors, such as capital markets, cultural environment, regulatory environment, political and economic environment, global standard setters, and other users. For the source influence on accounting standard and practice, all factors are shown are significant. The importance varies by country. Capital markets refer to equity and debt market. Lenders are considered to be bondholders, bank and private equity fund. Cultural issues cut across all countries and strongly influenced by the development of accounting. For the cultural difference in accounting, the figure provides some historical context. The accounting practice of various groups of countries. The vertical axis reflects practice according to transparency versus secrecy. The difference in measurement among countries are interest to international investors. Measurement means how companies value assets. Germany, Switzerland, and Japan rely on bank financing and have less disclosure than more transparent US and British. Optimism and conservatism are degrees of caution that companies exhibit valuing assets and recognizing income. As a result, those companies tend to be very conservative when recording profits that keep them from paying taxes and when declaring dividend to pile up cash reserves to service their bank debt.
So now on to transaction in foreign currencies. And when a company have to do business outside of the domestic market, they will have to keep track of recording and accounting asset, liability, revenues, and expenses when they have to deal with foreign currency. So on to recording transaction. When an importer want to like buy something from an exporter, they will need to trade in that currency for the exporter currency so that they will be able to complete the payment. So we'll have a look on the case on the left first. In this case, the US company is buying from a French supplier, and we also assume that the payment is on time. So the product costs 5,000 euro, and the exchange rate at that time is $1.45 per euro. So after we do the conversion, the product cost will be $7,250, and the account payable, which is basically the amount of money the importer owed to the supplier, is also the same as the price of the product because they paid on time. But if we look at the second case on the right, the exporter in this case extend 30 days credit to the importer, and by the time the payment was due, the exchange rate has actually changed from 1.45 to $1.5 per euro. And in this case, the account payable before is the same, but there is the foreign exchange loss of $250. This is because the amount of money that the importer need to be able to trade in for the amount of money to be able to buy the product for the pay for the product is different now. So we have here that the foreign exchange loss is $250 and the account payable is $250. And by the end of the quarter, if the exporter is not paid, the payable before we have to be updated using the new rate. So we'll move to the right, and the account payable here is before it was 7,250, but now it's $7,500. So the cash that have to be paid will be also 7,500. This is assuming the settlement is made following the end of the quarter, like months after the end of the quarter, and the exchange rate is still 1.5 like before. So this is another case in that the US company is actually the exporter instead of being the importer, and they're expecting to receive a foreign currency. And the account receivable was $7,250, and the sale is the same, but they actually got seven cash of 7,500, so there we have a foreign exchange gain of $250, and the account receivable was 7,250. So this will have to be recorded. So what should they do? That's actually These are the position they should do for that. It should record the initial transaction using the exchange rate that's in use on the date of the transaction. They should also record the receivable and payable on subsequent balance sheet date using the exchange rate on those dates. And the gain and losses before should also be in the income statement as well. So now on to translating foreign currency financial statements. So for this, we have two keywords that we have to keep in mind: translation and consolidation. Translation basically is the process of changing currency in term of another currency, while consolidation is basically the combination of all translated financial statement combined into one entity. So now on to the translation methods. There are two methods. The first one is the current rate method, and it is used when the local currency is the functional currency. The other method is temporal method, and it is used when the parent reporting currency is a functional currency. So what is functional currency? Functional currency is the main currency of the primary economic environment in which the entity operates. So for to give an example, if a business is operating in Japan, then their functional currency would most likely be in yen. But if it is in the US, and it'll be the US dollar. If it's in Thailand, then it'll be the Thai baht, and etc. etc. You should get the point. So now on to selecting what translation method we should use, and it depends on the functional currency. So if we are using the local currency as the functional currency, then we will pick the current rate method. But if we are using the reporting currency of parent, then we will be using temporal method. So to start off with current rate method, an example for this would be Coca-Cola in Japan. In Japan, the functional currency will be the Japanese yen, which means that, and for current rate, mean that all asset and liability are translated using the current exchange rate at that time. So while the income statement item are translated at the average exchange rate, and the owner equity is translated at the rate in effect when the company issue capital stock and accumulated retained earning. But on the other hand, if functional currency is the parent currency, then the temporal method must be used. Cash, marketable securities, and receivable, as well as liability, are translated at the current exchange rate, while inventory, property, plants, equipment, cost of goods sold, depreciation expense, and the owner equity are translated using the historical exchange rates. What is the historical exchange rate? It's basically the rate in effect when the asset were acquired. So now on to the next page. This is a table. So the table is the balance sheet, but before that we have to establish what the rate are. So for the first rate here, 1.6980 is the current exchange rate of the day on the date of December 31st of 2018. But 1.5606 is the exchange rate during which the ending inventory was acquired, and 1.5 is the historical exchange rate when the fixed asset were acquired and capital stock issued. So we'll first look at foreign currency. The total asset is 180,000. Like for example, the cash will start off at 20,000, but when we apply the rate conversion, will get this number. The rate is same for both temporal and current rate for now, so the number should be the same. But the inventory is actually different because current rate, as you can see, most of them use the same rate, which is the current exchange rate 1.6980, while temporal method use 1.560, which is the exchange rate during which the ending inventory was acquired for this. So as you can see here, the total number will be different because the rate is different as well. So on to like the capital stock that are using the same rate. For all of this, they're using the same rate, so the number here is pretty much the same. But the total liability and the owner equity are different due to the different in exchange rate between these two and some of the other here. So on to the income statement. For sales in foreign currency is 230,000, and then when you apply the rate which is the same for both. You get the same number in dollar, but the rate for these all these are the same, but here it's different. The 1.56 actually the historical exchange rate for the cost of goods sold. That's for this one. So if you look at the number, it's different because in temporal method in dollar is only $171,600, but in current rate it's actually 171,787, and the depreciation is also different. For temporal methods, they're using 1.5, but in current rate they're using 1.5617. So the number will be different, and therefore the consolidated net income of the temporal method and the current rate method will be different.
Now we will be talking about the international financial issues, which are composed of these four topics. And we will first be going into capital budgeting. So, capital budgeting is a technique that helps multinational enterprises determine which projects and countries will receive its capital investment funds. And there are three approaches that a firm or a company could take when it comes to capital budgeting. The first one is payback period. These are the number of years required to recover the initial investment made. And it is the estimation of the annual after tax free cash flow. It presents value and time to regain the investment. The second one is net present value, or NPV. It determines the current value of the project. And the NPV is calculated through a formula to which the outcome of the project is determined by its calculations. So it's the estimation of the annual after tax free cash flow from the investment, determining the present value of the future cash flow for each year, and then determining how many years it will take to regain the initial investment. So as you can see, the NPV is calculated through this formula, and these variables are defined by these on the left here. Our last and final approach to capital budgeting is the internal rate of return, or the IRR, and you have to compute the IRR and compare it with the rate of return. And if the IRR is greater than the required rate of return, then it would be determined as a good investment. So, through the computation of the internal rate of return of the project, the rate that equates the present value of future cash flows with the present value of the initial investment, and compare it with the required rate of return. Now, these three approaches have similarities. Is that among these three, the firm needs to determine free cash flows and estimate it. And they also have to consider taxes. And as for specifically NPV and IRR, they both need to determine the required rate of return. However, there are some complications in capital budgeting. One of these is that the parent's cash flows must be distinguished from project cash flows. Another is the remittance of funds to the parent. These are the differing tax systems, legal and political constraints on the movement of funds, local business norms, and the differences in financial markets and institution functions. There are also differing rates of inflation in across countries, different countries, and there are also difficulty in evaluating terminal value, possibility of unanticipated exchange rate changes, evaluation of political risk in a target market. Now we will be talking about the internal source of funds. Now, funds means cash, but it generally refers to working capital when it comes to business. So we will be talking about how the multinational enterprises handles its funds. First is through its internal funds. From here, from the picture, we can see that company-wide increasing in funds is all through loans. There is equity capital from the parent. Subsidiary funds could be giving back to parent through return on capital or cash. Merchandise, people, and financial flows can travel between subsidiaries, giving rise to receivables and payables. And you can easily move money between and among related entities. Now, we tackle into this question how to manage cash efficiently. Now, we will dive straight into the global cash management. And through these three questions, we will learn how to manage cash efficiently. So, the first question: what are the local and corporate systems needs for cash? The local system cash needs refer to the specific requirements for cash at the subsidiary level. It is also assessed through cash budgets and forecasts, and it determines the excess cash available for investment or other purposes. And one thing to take note of is that the cash manager must consider factors such as operational expenses, working capital requirements, and local market conditions when determining the local cash needs. But for the corporate system needs, it refers to the overall cash requirements of the multinational enterprise at the regional or headquarters level. It is also assessed through cash budgets and forecasts, but it has a higher level of aggregation. And the one to take note for this is that the cash manager must consider factors such as capital investments, debt repayments, dividend payments, and overall liquidity needs when determining the corporate system needs for cash. Second question: how can the cash be withdrawn from subsidiaries and centralized? And this is through accessing local cash needs through its budgets and forecasts. The cash manager may allow the local manager to invest any excess cash in the subsidiary, and it can centralize the cash by transfer into central cash pool through dividends, royalties, management fees, or repayment or principal and interest on loans. The last and final question on how to manage cash efficiently is that once it has been centralized, what should be done with it? One thing is to distribute the cash through a cash dividend. The second thing is to remit the cash to royalties, management fees, or repayment of principal and interest on loans. The next part we will be talking about is how the M&E handles its funds through multilateral cash flows. Cash can be transferred among subsidiaries of MNE for a variety of reasons, in the form of loans or as proceeds from the sale of goods. If there is no cash management center, as you can see here, each subsidiary must settle their accounts independently. This is through their receivables or payables. Next is through net positions. Again, if there is no cash management center, they must settle their accounts independently through the same way as before. Net positions, the difference between total receivables and total payables. And this is determined on a subsidiary by subsidiary basis. So next is multilateral netting. So this one has a cash management center. In other words, a clearing account where each subsidiary transfers its net cash. And four transfers will need to take place because there are four subsidiaries in this case. And the clearing account manager receives transaction information and computes the net position.
Foreign exchange risk management. There are a total of three types of exposure, first being translation exposures. This refers to the risk faced by a company when its foreign currency financial statements are translated into the reporting currency of the parent company. It is necessary to combine the financial statements of different companies within the corporate group to form consolidated financial statements. For example, consider a US company with subsidiary in Mexico which has 90,000 pesos in bank. They sell books in pesos but needs to be translated into dollar. Exchange rate changes from 18.5 USD to 20 USD. This originates from $48,649 to only $45,000 left. Keep in mind that exchange rates are not fixed, values are changed frequently. Second of type exposure being transaction exposures. These risks are faced only when the company made transactions on accounts that can receive or pay money in foreign currencies. Now, for example, if a US company export $500,000 worth of goods to British importers at exchange rate $1.9 per pound, this would come to 265,158 pounds. Now, if the importer pays in USD, there will be no immediate effect on the exporters. On the other hand, when received in foreign currency, which is pounds, the price of the received currency might drop or changed. Now, for example, if a pound rise in price and the dollars dropped to $1.88 per pound instead of 1.9, the exporter will receive only $494,737 back, losing them around roughly $5,000 in the progress. Third type being economic or operating exposure. This means that there are potential for change in expected cash flows that were affected by various things. This has both immediate and long-term effects on cash flow. Taken from previous example where we export goods from US to England, if the exporter were to receive in USD, the foreign exchange risk would be transferred to the importer instead. Now the importer can either sell for the same price and earn less profit, bringing less profit margin, or they can raise the price of the goods and hope the consumer would pay. To manage exposures, we need strategies. And those strategies being define and measure exposures, organize and implement a reporting system, formulate hedging strategies. To start with define, um, firstly, we need to predict the exposure to major currencies which it operates with. We also need to keep track of translation exposure separated from transaction exposure because transaction exposure may not cause a cash flow, while transaction will certainly cause a cash flow. They also need to predict exchange rates to gain the most profit. Secondly, organize and implement. Once they decided on define and measure exposure, they need to create a reporting system that will assist in protecting the company against risk. Collaboration of foreign operations combined with effective central control is also required for this progress. Lastly, formulate hedging strategies. Once they have identified level of exposure and critical exposures, hedge is a position by using financial strategies. The safest position being balanced, which means exposed assets is equally to exposed liabilities.
So, in conclusion, we have discussed issues on international accounting and financing. Now, these were in the topics of the crossroads of accounting and finance, the factors affecting the development of accounting objectives, standards and practices, international accounting standards in the process of global conversion, and how companies account for foreign currency transactions. And what we discussed today also covered how companies could translate foreign currency financial statements, the key international finance functions, and how companies can protect themselves against foreign risks. So, through these topics, we have provided you the insights into the complexities and challenges faced by companies operating in the global market and highlights the importance of understanding international accounting and finance principles. That would be it for our presentation. Thank you and hope you enjoy the rest of your day.